Welcome back to this tutorial on how to trade during the news without getting slaughtered. I've just allowed my chart to load to the most recent event. So right now, if I put on the data, this is where the current price is. So, but I have just put it off so that nothing interferes with this because of its importance. Now, out of all other videos, tutorials I have done, this is one of the tutorials that will solve the biggest problems traders face every day, and that is the conflict between fundamental analysis and technical analysis. Now, I'm going to use my simple technique to solve that problem so that that conflict will be put to rest once and for all, and it's very possible. That is what I'm going to show you in this video. So first thing I want to do once again is to remove everything on my screen to make sure you see how everything is plotted. So I'm starting with a blank chart, no indicator, no analytic tool, and I'm going to start from the very first step to take. Now, starting from the beginning of the day, let's leave what is in future in future. So the day began here, and all of these moves before they happened, let's take you back to the previous day and let's see what happens. So now the previous day, of course, the market uh, ended while making bullish runs. Okay, the market ended while making bullish runs. That is from the most recent event that ended the previous day. The market was moving upward. So it means that for the new day, you want to see a continuation of an upward movement, at least until a point of saturation. Now, on a day where you are expecting a high impact news like the CPI news, you want to make sure you have taken enough trades before the news. You don't just need to sit idle and wait for the news, because it is in the course of trading that you will be better positioned for the news and before the news, which means that with a good entry before the news, you will be one of the safest traders to make the most profit from the news. Without that, you will be lost in the market and be trapped by the news. So my objective for this tutorial is to make sure that you don't get slaughtered by the news ever again. So where do we start from? Having seen how the previous day ended, that the market was in an upward trajectory. Then the new day, you are present with the market and the market just opened. You haven't seen anything new until at least the first three candles are fully formed, okay? Now within the first hour, of course. So now in 15 minutes, what do we have here? The first candle was a bullish candle, second candle bullish candle, and third candle closed bullish. That tells you that the market is bullish. And this already meeting the impulse criterion means that you need to mark the impulse that has just formed. So where do you start from? Start by marking the starting point of your impulse, and that is called the impulse start level. So this is how to mark that impulse start level. Use a slab and place at the opening price of the candle that began the impulse, or the low, whichever is more dominant. So if there is no clear low, then you mark the opening price of the candle that started the impulse. If the candle made a low, then you mark the low of the candle that started the impulse, and then set it to reflect on only the time frame of observation, and that is what I have just done. So now we have the first level marked, and that level is called the impulse start level. The next level to mark is impulse break or continuation level. Impulse break or continuation level. So again, use a slab and place on the closing price. Okay, let's say that correctly. Use a slab and place on the, since it is a bearish break, place it on the high of the bearish break. If it was a bullish break, you place it on the low of the bullish break. And for bullish break, I'll use the red or crimson color for my slab. And the slab is filled already by default because I've already set it to fill. I can check it here or check it to fill, so it shows my color. Okay, so now I have seen the two levels that have formed. The next thing I want to see is the turning point of the impulse break. Turning point of the impulse break. Now I'll use a horizontal line. I've already selected my color before now. So my color for the turning point is gold. So I use gold color to mark the turning point, and that is here. Highlight to make sure it reflects on only the time frame of observation. So now I've marked the first three levels that are clearly seen in what the market has done. So my interest in what has happened is continuation. I want to see a continuation of the given structure and direction of the market, which means since the market is buying, I am expecting buy continuation. I am going to look for the next buy when two things happen. And those two things will be when I see an impulse like this that gets broken, the first thing I am expecting is that the impulse break level, which is also called the trend continuation level, has to be broken after forming. Now, when it forms, the impulse break candle will close below that high formed in a bearish impulse, okay? While in a bullish impulse. In a bullish impulse, the bearish break will close below the high formed, which means that price will start from within, okay, the impulse break candle and move back to the high of the bearish break. Okay, so you want to see when the break is broken. That's when the impulse break level is broken. You want to see how the market reacts to it and rejects it. Then you take your entry. So typically, this is my entry guide. After the break is broken, you want to observe three candles for your entry. First candle, which is the break. Second candle is your observation candle. Third candle is your confirmation candle. And the next candle is your entry candle. Those three candles are always to be observed. So that is the rule for trading any impulse break. Now, it's not guaranteed that your entry candle will be close to the level. Entry candles can be far from the level. So how do you still take that entry? Take that entry if the measurement between your level and the entry candle is not above 10 pips. It's not above 10 pips. If it is above 10 pips, you have to wait for that level to be retested, rejected. Then you enter after the next rejection. So now let's measure that level from the high of the impulse break, 1.2741. Okay, and we saw this as the entry candle. That is below 10 pips because it's opened at 1.2745. So it's less than 10 pips. That means this is a qualified entry candle for the ongoing impulse. Now, having taken that candle as your entry candle, your take profit will now be set until, first of all, your time frame tells you that you can expect up to 40 pips minimum profits. You can expect up to 40 pips minimum profits. However, you can always break your profit into profit 1, 2, and 3, which means you can have profit from 20 pips, have next profit from the next 20 pips, and another profit the next 10 pips. So, because the market moves in a 20 pips circle, then it corrects, another 20 pips circle, then it corrects, another 20 pips circle, then it corrects when it is moving in any trend. Okay, so for the entry given at 1.2475, the take profit one will be at 1.24, 1.2765, 1.2765. That will be take profit one. And you can see the market got to 1.2765. So because you took an entry here, your stop loss will be 10 pips below your entry, and that is 1.2735, 1.2735, which comes very good and safely back into that impulse zone. So allowing the impulse break level or continuation level to act as a support level. So where the market will have to break it in order to hit your stop loss. So your entry, first of all, is safely set. And that is why you should make sure that your entry is within 10 pips spread from the level, within 10 pips spread from the level. So now, all of these moves that happened here means you are not going to worry about any other entry again until you exit the current entry. That is the standard rule. So 20 pips first take profit, and if the market makes another move, you find another entry from there when you see a structure for an entry again, because the market always makes a 20 pips move, then correct, 20 pips move, then correct. So let's look at having exited that entry, what happens next. Of course, all of this now becomes levels that the market made a new impulse. You're already in the market before the new impulse broke. You can mark that level and continue, because in future the market will react to that level. In future, the market will react to that level. But this was your first level that you marked. So I will mark the levels again so that you see how all the levels formed, and you can become good at doing that yourself. So after any impulse break and there is a new impulse, you mark again the start of the new impulse. And since it's a bullish impulse, I'll use a green or blue slab to mark that. Select only the time frame of observation. So I've marked the new impulse level and then new impulse start level, and I'll mark again the new impulse break or continuation level, which is set at the high since it is a bearish break. So, and again for that break level, I'll use a crimson or red slab to differentiate the two. And I maintain these colors, of course. So now we've got new levels marked, and I call this slab pattern. This slab pattern can serve as your high and your low to know the structure of the market. You actually want to see in a bullish impulse the slab low and the slab high. You want to see a low increasing upward. So the previous low should be lower than the recent low. Okay, so you want to see higher lows and then higher highs. So that's to show that the structure is bullish. So you are marking the low of the impulse start level in a bullish trend and the high of the impulse break level. Remember, I've mentioned that. So when you see those slabs, they represent your high and your low, and by clearly demarcating them, you can easily see higher low formed. So the recent low is higher than the previous low. The recent high is higher than the previous high. So higher highs and higher lows. So now, having done that again, the next thing to mark is the impulse break turning point, and there again I use this horizontal line to mark the closing price of the break candle. Always the closing price of the break candle for the turning point. Now, I've explained what this does when you mark it in a previous video, so I don't need to repeat that here. The objective of this video is to take you to the point when you will know how to trade the news before the news in order not to get slaughtered by the news. So now again, this is like a new structure forming here. But remember that there is no need for a new entry unless you did not take the previous entry. Always also, when you see a new structure, always validate it with the previous structure so that you know if the previous structure has at least made its full profit before you start calculating a new entry for the new structure. Okay, so let's see. The previous structure's entry is still yet to make full profit, so the current structure can be traded or ignored as the case may be. But let's take it that this recent structure is to be traded. This is a low and this is a high. So the impulse break level or continuation level, once it is broken, we'll start doing again our entry criterion, applying it as first observe the break of the level. Then after that break, you have the candle called the observation candle. Then you have the confirmation candle. The next candle becomes your entry candle. You want to make sure that all of these candles stayed above the level once it is broken. That is the only condition for entry. If any of these candles return back into the level, it automatically cancels the validity of entering on the level break. Okay, so if the break opens and after uh, closing above the level in a bullish impulse level broken, then you want to see the observation candle opening and closing above, okay, that level once broken. Then your confirmation candle should do the same thing, open and close above that level once broken, and then your entry candle should also open above that level. Remember again that the distance between the level and the entry candle should not exceed 10 pips. Then you can take an entry. So let's measure again. The level is 1.2750, and then the entry candle is 1.2755. So that tells you that it is less than 10 pips. This is a qualified entry for you. So qualified entry, once again, tells you that you can take that trade and set your take profit again in parts, like take profit 1, 2, and 3. First take profit will be 20 pips. Second take profit again another 20 pips, and the third take profit will be 10 pips. That's 50 pips for the M15 time frame. Maximum 50, minimum 40. Okay, so that is to say you took your entry here and then the market made an impulse to confirm that you took the right entry. Now, all of these moves, you have your entries there, which means you have had now two entries taken. First entry running, second entry running, all corresponding to a bullish trajectory of the market. So now, taking further observation of what happened next, again you see an impulse formed and you want to repeat again what you did here to mark with your slabs those levels I have mentioned. So going back again, you start with the impulse start level, the new impulse start level. You will mark that level again with a slab. So if it's a bullish impulse, I prefer to use a blue or a green slab to differentiate it from the impulse break level. So whenever I see the blue slab, I know that that place was a start of a bullish impulse. In a case where I'm measuring the bullish impulse, then I use a crimson or red slab for the break of that level. Again, when you do not see a clear high, you place it on the opening price of the break. And that is what I've done here. set the color to crimson, and select the time frame to reflect only the time frame of observation. So right now again, we have a new level formed. We have the impulse start level and the impulse break level formed. So one more thing to add there is the turning point. So adding the turning point now, and turning point is set at the closing price of the impulse break candle. So highlight again the time frame. I prefer to use the gold color for my turning point. So now I've got that again. Once again, the rule that applies is the break of that level following all I have said in the previous levels. So again, the structure continues to be bullish because we have higher high, the recent high is higher than the previous high. Again, the recent high is higher than the previous high, and then higher lows and then higher highs. So the recent high is higher than the previous high. This once recent high was higher than the once previous high, like that, and it continues. So now again, where next am I expecting to take an entry? First, if the market is buying, you look for buy entries. If the market is selling, you look for sell entries. When the structure giving you is an impulse structure. Once the impulse structure starts giving you is string structure, you now start looking for another type of entry. So right now, I'm only trading what is called trend continuation entries because I have not seen any string formation opposite the bias of impulse. So when I say a string form opposite the bias of impulse, then I can take an entry following the string break entry. Okay, so right now we are looking at the level and its break. So the level is measured at 1.2764. That's the impulse break level, 1.2764. Okay, now where did the break occur? There must be a break, and then all other candles after it should stay above that level. So the first break occurred, but the observation candle went in back into the impulse zone. Okay. Then again, the second break occurred. Observation candle stayed correctly, but the confirmation candle went back to that zone and closed just within the zone. Then the entry candle opened and closed within the zone. So again, you look for another break of that level. Again, the next break occurred. The observation candle closed, of course, on the zone. The confirmation candle rejected the zone, but the entry candle went back into the zone. Then again, the next break occurred, so no entry yet. Observation break candle broke. Observation candle was clear, and then the next candle that formed was your confirmation candle there and your entry candle. So right now, when you see the entry candle all meeting your requirement, you want to measure if it is within the 10 pips. So measuring that 64 to 69, that's within 10 pips. So you took a buy. Okay, so now that buy you took, your stop loss is 10 pips. So if the market goes and triggers your stop loss, you know that that entry is lost. You now reevaluate and see if what is happening next will mean that the market is no longer interested in moving in that direction, and you find your latest or new entry in the new direction. So let's look at that. That entry taken at, this was the break, observation, confirmation, and entry. The price is 1.2768. It means that your stop loss will be at 1.2758. So let's see when the market came down 1.2758, it of course triggered your stop loss. 1.2758, it triggered your stop loss and went back uh, there, but stayed now within this zone. Okay, so your third entry was a loss, while your two other entries were still held in profit. Now let's look at what happens. At this point, you have not seen a new impulse break structure, okay? But while you were waiting for an entry, a new impulse formed. And you want to just mark all of those new impulses that formed for making sure that your chart is up to date. So let me first of all mark all of those new impulse structures are formed. So again, this was an impulse start level, and then I use the green or blue slab to demarcate it as a low, and then a high, I'll use a red slab. So impulse start and measuring the high of that candle, I'll use a crimson or red slab, highlighting only the time frame of observation. So right now I have measured that. So an impulse formed there and broke there around that zone, and it happened within the turning point and the previous impulse break level. So that tells you that the, the market has become or entered into a consolidation phase. And you know what happens when the market consolidates? It is sign that the market would want to correct or do what is called, if it was buying, do what is called distribution. And then after distribution, the correction will begin. So you want to see the market entering into a phase and come back into a circle as it is. So now we found so many points of we are looking for a buy entry on a continuation of the bullish move. So far, we have not started looking for a sell entry yet. So each time we see a market coming into the structure, we know that the market is consolidating. And in one of the videos I have done, I said you do not take entries inside of the consolidation zone. Where is the consolidation zone? The spread area between the recent impulse break level and its turning points. The spread area within the recent impulse break level and its turning points. So whenever the market is within that zone, that is a consolidation zone for the market. It does not matter the size of that spread. That is a consolidation zone. So that will be determined by how long the impulse break candle was. That will tell you how wide the consolidation bus will be. So, and that always happens because after any impulse is broken, two levels are formed, which are the impulse break level and the turning point. And all of them are determined by the very candle that made that move to break the impulse. So now you notice that when this impulse was broken, it set its high, which is at the high of the break, not the high of the candle, of the last candle of impulse, rather, but the high of the break. So it set its high, and then a new high formed when a new impulse formed that attempted to break its high. So that also gave us a new turning point, which I did not add there. So adding the turning point, I can easily adjust this to the most recent turning point, which will become the new turning point for observation until a new impulse forms again and I adjust it to the next turning point. So far, the market stayed within the consolidation zone, like I said. Every new turning point would increase or change the consolidation zone because of the impulse that gets broken, most recent. So you're paying attention to the most recent structure. So now no new impulse formed. A structure is there that has not been broken. So you know that that's the consolidation zone. The market is within the consolidation zone. And you want to see it come out of the consolidation zone by breaking the impulse or entering into a correction. And what is correction? Correction is when the market breaks the turning point and goes back to retest the impulse start level. So that's correction. So right now, no correction yet and no trend continuation. So you want to see one of those two things happen. Okay, so what happened? This was where the market attempted to break the previous impulse, okay, impulse break level, and failed to give you an entry. So no new entry, a new impulse break. Yes, a new impulse break level was formed here. So let's use a new impulse break level to see that what happened next. Okay, we've already looked at that. So we saw a new impulse formed here. So let's mark the new levels because you have to update your observation so that you don't judge with the previous. The market uses the new event to alter the structure of the previous. So if you are not current, you might be left behind, holding on to the previous that has already been altered to justify the new move that the market will make. And if you are current, you will never be left behind or taken unawares. So you have to always update your observation by marking the most recent levels that form. It is not uh, too burdensome to do. It's just to mark the three levels that form after any new impulse. That's the one task you must continue to do actively as you observe the market actively. So there is no excuse for that task. So again, I'm using the colors that are meant for that. Let me uh, choose the color crimson for the high in a bullish impulse break. So bullish impulse that gets broken, I'm using crimson for the high. So then again, I'll adjust the nearest turning point to the new turning point. So nearest turning point, I'll take it to the close of the candle that broke the impulse, which is called the impulse break candle. So turning point has been adjusted now to the new price. And now that we have that set, we want to see again when the market will enter into a correction phase, okay? And also when the market will either do what is called trend continuation. So trend continuation is when the most recent level is broken and your entry criteria or criterion is met. That is, you want to see a break, an observation candle, a confirmation candle, and an entry candle all occurring above the broken impulse break level. So that is most important to note. Then when that has not happened, a market enters back into the impulse zone between the impulse break level and the turning point set at the closing price of the break candle, you see the market consolidate. Then when the market breaks the turning point, you expect the market to correct. And the correction lasts as long as the new impulse start level has not been tested and broken. So as far as the market stays between the zone of the turning point broken and the untested and unbroken impulse start level, you call that correction. And then when the market breaks the impulse start level, you call that trend change. So those are the three things you are watching for on the structure of the market you are trading, following that alone. So let's see what the market did next. Now, the market has been bullish all the while. And after consolidation like this, in fact, you are not calling this consolidation because this is happening as what you call distribution when it happens after an impulse. You call it distribution, especially when the trend has made three circle moves. So let's see this happen. That's three circle move. By three circle moves, I mean you saw first high and low form, second high and low form, third high and low form. So three high and low you have seen marked already. The market is due to do what is called a proper distribution and then potential correction. In fact, what always happens is correction because the market exhausts its direction and needs to relax a little to gain momentum to continue in that initial direction until it breaks the last level that it created before the correction. So that is what the market phase and circles are about, and you have to understand the market phases and circles. So the impulse is a phase of the market and the correction is a phase of the market. While the circles are the distribution which happens at the end of the impulse or the last impulse. Then you have the accumulation, which happens in the middle of the impulses. So the three levels you saw, that is the first high and low forming successfully, then the second high and low forming successfully. At that zone where you have the second high and low forming is where you expect distribution to occur. That's where you expect accumulation to occur. That is new entry. Of course, it is called accumulation because in the new impulse, you find a new entry when the level is broken. That's why it's called accumulation. Then you have consolidation when the first level is about to form, which is the first low in a bullish impulse or the first high in a bearish impulse. Okay, so those are the three levels that form that structure before you see a distribution. So after the distribution, then the market enters into a correction phase. Okay, so now that is what you're expecting to happen. The market haven't made three circles. You saw low, one, high, one, low, two, high, two, low, three, high, three. The circles complete. So you want to see distribution phase, and then you want to see the market try to attempt to break the level, the last level formed, and then break the turning point and now enter into a first correction phase. First correction phase is when it tries to return to the most recent start level, impulse start level that has not been tested and broken yet. So it is until the market breaks the most recent impulse start level that it will try to engage the previous impulse start level and then again the previous impulse start level. So you can see that happening here. It broke this most recent impulse start level. Okay, it broke this most recent impulse start level after encountering it for the first time. It encountered it for the first time here, but there was already one earlier one here. So it encountered that for the first time, rejected it, okay, came back again, encountered the two, rejected them, then again it remained in the correction. So this is called correction. So now you trade correction. Of course, if you trade the trend impulse, you also trade correction. So when the market enters into correction, what you do is you trade opposite the bias of impulse. That is trading the phases of the market. And impulse or correction rather goes to recover all the move of the impulse. Now, when the correction goes to recover all the moves of the impulse, if the impulse start level is broken, a new direction of the market is expected. So if the market was in a bullish impulse, it will start doing what is called bearish impulse because the first phase of correction has ended. And then if there are other impulse levels that have not been tested yet, the market will attempt to go and test those other impulse levels. That is what forms the new impulse direction. Okay, so in the situation where the impulse, last impulse start level has not been broken, the market will remain in the correction zone. Okay, so now let's see, where would you take your next entry when you expect correction to happen? Now, we are going to follow the correction entry rule at this point. Correction entry rule states that once the most recent turning point of the most recently broken impulse is broken, that's when that turning point of the most recent impulse is broken, you want to see the market show a clear rejection of the turning point so that it doesn't return back into the consolidation zone. Then you trade as soon as you see the rejection and you take your entry within 10 pips. Within 10 pips of, again, that level formed by the turning point, because the turning point itself is a level that the market rejects and respects. So just like your impulse end or impulse break level, so also the turning point, the same rule applies. But in this case, all you want to see is the market rejecting the turning point after breaking the turning point. You want to see the market show a clear sign of rejection, and within 10 pips, you take your entry after the rejection is spotted. So this was the break that occurred after the most recent turning point was broken, and this was the candle's opening price. It went to do what? Test and reject, test and reject the turning point up until it closed. Now you see that it has tested, rejected, and closed bearish. That tells you that the market has recognized the level formed by that turning point, and you want to take your entry on the next candle. Okay, so how to take that entry? You can take it at the opening price of the next candle immediately. If that opening price is not longer than 10 pips, okay, from the level of the turning point. So let's look at the level of the turning point, 1.2768, and here is 1.2763. Okay, that's 5 pips is within an entry comfort zone, because it means that your stop loss will be safely above that level formed, okay, where the level will now act as what? A resistance in this case, because it was a bullish impulse that formed the turning point when it was broken by a bearish candle. So here becomes your resistance. Your first resistance will become your turning point, and your second resistance will become your impulse break level. So you have two resistance to support you if you take an entry within 10 pips after the break of the turning point. So this entry is correct. Then if the first candle that opens after the turning point was broken is longer than 10 pips, you have to set your entry as a pending order very close to the turning point. You can set it within 10, within 2 to 3 pips of the turning point, 2 to 3 pips of the turning point, to allow the spread also that is charged when the market goes to test the turning point. You don't have to set it exactly at the turning point, because the spread may not allow your entry to get activated. So if the market charges 3 pips spread, it means that you have to calculate the 3 pips spread to set your entry 3 pips from the turning point. So when the market attempts to go to test or retest the turning point, it will find your entry and take you into the market to trade the correction. Then the correction is taken up until when the market goes to retest the impulse start level. Now, because you do not know if the correction will end at the impulse start level, ideally you take your entry and set your take profit for a correction entry measuring from entry price first to the end of, or rather to the start of, the impulse, the most recent impulse that you are trading is correction. Okay, so in this case, this was the most recent impulse, 2758. That's its level, 2758, and your entry is coming at 2763. So that's about 5 pips profit only, because you do not know if that level will break, of course. So now the market returns back after retesting that and has not broken that. Now, when the level breaks, you find a new entry because the level has broken, okay? While your previous correction entry has been exited. Now, that is an entirely uh, new experience, or that's an entirely new event, different from what happened during the correction, because the impulse could be very long. So you have to know that your exit is at the close of, or is at the impulse start level. You measure the impulse start level and set your take profit, considering the spread your broker charges. So if your broker is charging you 30p spread, you measure the level. Since it was a buy impulse, you add the 3 pips on it and then set it as your take profit for your correction entry. So once you've traded correction, you observe the market again and see what happens next. So you have two things to expect. You have a return back into the structure to break the turning point, break the level, and continue the trend. Okay. Or you have a break of the impulse start level for the direction of impulse to change, where you will see new impulse in the opposite direction. So now what you do when you find that happen is you take your entry from the break of the level, just the same way you take your entry during correction, okay, from the break of the turning point. What do? You want to observe the break and see that there is a rejection of that level. Okay, so the impulse start level once broken, you want to observe the break, and your entry again must be within 10 pips because of your stop loss. You are using 10 pips stop loss, so your entry must be within 10 pips. If the candle that breaks the level is longer than 10 pips, then you must set your entry within the level that was broken, considering the spread, just the same way you did when trading correction. Okay, so let's measure the level again. The level here was formed at 1.2758 and the break closed at 1.2752. So that's within 10 pips. So if you took your entry on the candle that opens after the break, that will be correct. Okay. Then if the candle opened below 10 pips, then you could set your entry as a pending order. Of course, if the market does not move the first 20 pips, that pending order is only valid if the market does not move the first 20 pips into profit, because I've explained that the market makes a 10 pips profit move for one cycle of that movement to be complete. Okay, so let's look at that. You had your entry taken here, but I've explained that if this break candle had gone further than 10 pips, you could not have entered immediately on this candle because your stop loss will not be safe. So you would have only set a pending order at the level, but calculating the spread chart. So the broker is charging you 30 pips spread, you calculate the spread and might subtract it from that level in this case, since you are selling, subtract it from the level. So if the market is 1.2758 at the level, your entry will be at 1.2755. 1.2755 will be your pending order. So that's how to set that. So right now your entry is here and your take profit is 20 pips because this is a new event happening in the market. You don't question that. You don't question that take profit because the market it has already entered into a new zone, which is an uncharted water. Yeah, it has to go as much as one full circle, which is 20 pips. So let's look at the entry price 1.2753 and see if the market made it to take profit for take profit one. 2753, the market made all the way down to 2732. So that is complete 20 pips and one. Okay, so 21 pips, which means that the market made a full circle of that move. And now that impulse start level that got broken has given you a good entry. Okay, so now remember that why the market broke the first impulse level, it goes to encounter previously untested levels, which are also formed as impulse starts or impulse break or turning points. So you pay attention to that, how the market reacts to those next levels when it encounters them. So if you look here, you see that the market came to encounter the turning point that was formed by this first uh, impulse break. Okay, so this is how the market reacted to it. The first attempt to it, market rejected. Second attempt to it, market rejected. And third attempt to it, market, after attempting to break, came back, closed, and rejected. Okay, but at least In that encounter, the market made it to your take profit. You see the funny thing about that. Now, I haven't seen this structure of rejection. It tells you that the market, because this is called turning point, the market, once rejecting a turning point, has to turn from there. That is why it is called turning point. Okay, or if the market comes to a level like this, let's assume that the market finally closed just the way it closed when the first turning point was broken, or the same way it did when this turning point was broken. Okay, if the market breaks the turning point, you expect it to come again into the next correction of the previous impulse that has not been tested. So I come to retest the start level. So the market will have to keep going down like this until it encounters a level that is strong enough for it to hold price there, and you experience a turn or reversal back into the main direction of the market. So let's look at that again. When the market could not, after three encounters, so the market could not close into the first impulse level,